Alicia Daniel Hall, attorney and realtor with eXp Realty, and I am here for Ask a Realtor. Well, here we go. What happens when you sell a home and you have a mortgage? Super simple. Once you're under contract, whoever's handling your closing, whether it's a title company or a title attorney, because it is different in different states, what's going to happen is your closer is going to reach out to your mortgage lender and they're going to request what is called a payoff letter. The payoff letter will show what your mortgage balance is plus any fees that have accrued, as well as interest through a specific date in the future. And the reason why they do that is because the payoff letter might be generated today, but the closing may not be for another 6 days. Obviously, the bank wants all of their coins. So they give you, this is what it's going to be through, next Wednesday, for example, okay? So now, whoever's handling the closing, they're going to add that figure onto the closing disclosure form. And so your mortgage balance and everything that's required in order to pay off that mortgage will be deducted from the proceeds of the sale of the home. So here's an example. Let's say you're under contract, your buyer's approved, your closing is scheduled, everything is going great, congratulations. The purchase price was $300,000 and your total mortgage payoff is $250,000. Your net proceeds from the sale in that instance is going to be $50,000. Of course, there are going to be other fees associated with the transaction that would also be deducted from that $50,000. But for right now, we're just talking about how that mortgage works. Now, let's talk about what happens if you actually owe more than the home is worth. So let's take that $250,000 payoff, but the most you are able to get a buyer to pay is $225,000. That means you are what they refer to as upside down. In that instance, you're going to, as the seller, have to either come out of pocket, $25,000 cash, or negotiate a short sale with your lender. You do need lender's approval because they must approve. They must agree to accept less than what is owed to them. And they're going to require, there's usually an application process and documentation that you have to submit to support the request. There will be an appraisal because again, or maybe a BPO. They will be valuing the property because they want to make sure that this isn't just some random, lowball nonsense, right? They need to make sure that it's legitimate. And then they're going to make a decision. When you have a short sale, understand that everything, including the realtor commissions, must be approved by the lender because they factor everything in when they're making that decision. The seller cannot receive any cash from that closing, from that transaction. That is a requirement that the lender is going to have. If you want them to accept less than they're owed, then you cannot make any profit as the seller on the transaction. But in a nutshell, that's what happens if you sell a property with a mortgage. Thank you.